Hello, and welcome back to Equity, TechCrunch's venture capital focused podcast. I'm TechCrunch reporter Kate Clark, and I'm joined by my co-host, Crunchbase's Alex Wilhelm. How's it going, Alex?
It's going really, really well. We raided the Yahoo kitchens. We stole all the coffee. And
every time you say
back.
Yahoo, I just can't deal with it.
My brain doesn't process it otherwise. But we have a really cool guest this week. So who's here with us?
We have Greylock general partner Sarah Guo.
Great to be here.
Did I get the name right?
It was close. Yeah.
It's hard.
We always really want to do well by everyone's name.
We do, yeah. I practiced, but
practice some. We have a fun fact, and this is the new thing to the show, and we kind of humanize the people that show up before they talk. And we asked Sarah, what is her fun fact? And she said, there's no fun. And I thought that was probably the best response we've had yet. So thank you for fitting
Appreciate the honesty, definitely.
7-year blackout on fun. Just venture all the time in SaaS multiples, which Alex thinks is fun. Yeah.
I mean, SaaS multiples are, I have a back tattoo that you can't see right now, but it just says, 10x or bust. And we'll see what happens in 2020.
Let's start with Grammarly. I think that's the hot topic of the week, right? Actually, the last couple of weeks.
Grammarly has been a surprise hit because I didn't think there was going to be enough consumer and SMB demand to actually pay for a product like this. But I've been wrong about similar things before. I didn't think that Office 365 for consumers was going to do very well. I thought it was too expensive and people wouldn't want to have a paid productivity service. But in this case, Grammarly, I think, fits in the same model of people are willing to pay for their own personal work if it actually helps them. So they raised a $90 million round.
Yeah.
At a
at least $1 billion.
At least $1 billion. So does that usually mean like $1 billion and $1, or are they just trying to be more coy than we think?
I can't say about this particular one. It's close enough.
Okay. Oh no, I meant in general as opposed to like in this particular case.
Like why wouldn't they just give us the exact number?
Yeah, because I think companies definitely like to go with like we hit this very large number and there's this glorification of very high valuations versus like does $1 billion sound better than $1 billion and 25K, which often happens as you squeeze people in. Yeah.
Oh, okay.
Right. Because in that case, that would make sense for them to just say 1 billion, but instead they were like, oh, it's over $1 billion, but we can't, it's near the, it's just very oddly, there's a lack of transparency.
It feels imprecise in a way that doesn't make sense. Like why not just brag about how large it is? But I guess if it's, 1.0025 billion, to your point, why bother? Okay. If you don't know what Grammarly is a tool that auto scans your written work as you type and provides actionable and useful tips on how to make kind of regular improvements. My impression of this tool is that it's for people who don't write for a living.
Yeah, maybe, but I mean, I use the free version and I find it helpful. Like it does plug into WordPress, I think.
Yep.
Yeah, so we use WordPress at TechCrunch to write all of our stories, and it plugs into my WordPress, and I mean, it definitely catches mistakes for me all the time. And I'm a professional writer, so I mean,
what I meant by that was the problem that I have with Grammarly isn't that it doesn't catch my occasional foible, because I make mistakes all the time. Every writer doesn't produce perfectly clean copy, but sometimes when I want to bend English a little bit, it freaks out. And like, no, you can't be stylistic.
But the thing is, you bend English 5,000 times more than the average writer.
Well, it's because English is fun to bend. But my point is there's no option to tell Grammarly, I'm having fun in this paragraph, leave me alone, which I struggle with.
Yeah, I think what you're saying is there's not a lot of ton of room for creativity. What I do like is they're launching something where I think their AI memorizes your style guide so they can actually correct based off your style guide, which I think is really cool. We don't really have a really strict style guide here at TechCrunch, but I've worked places that have really strict. Why is that funny?
You do have a style guide.
It's not strict.
It's not strict. It's more of a guideline.
It is there. It exists.
Yes.
But yeah, other places do have really strict style guides, like Crunchbase might. So I mean, that could be really helpful for those kind of more niche publications that have these really set rules.
Yeah.
Well, one of the extreme fears was, if you guys remember Google Inbox Smart Replies, it was like everybody's just going to automatically answer with the Google like 3-word answer.
Mm-hmm.
That was the appropriate answer. And we were all just going to be in this stream of everybody saying the exact same thing by email. And that may or may not have happened, but it's super efficient.
I rarely get emails that short, but if I do, I'd be thankful. If you just said, great, sounds good, I'm done. I don't need another paragraph.
Yeah, I use those automated replies on Gmail all the time, actually. Like, the thing is, sometimes they sound too happy, and I don't want to send, like, these really gracious exclamation point responses.
So, aside from that fringe use case, it sounds like people use them more often than we would have guessed. But, one element of this that I think no one talks about is the privacy element, because this is something that's reading your writing, presumably talking to servers, and, it is part of, you could say that it could spy on what you're writing. Now, I don't think that's a concern with Grammarly, but remember when Google was in trouble when Gmail was scanning your emails anonymously to provide ads, people were really worried about the privacy component to that. Now, in this case, it seems to be a non-issue. I'm curious if that's because we've changed how we feel about that as a public, or no one's just thought of it. But certainly that's still a possible error or something like this in this business model.
I think the trade has a lot to do with the business model. So like, first of all, I think consumers are getting a lot more comfortable with understanding like what is being done with their data. And with Google, like you get a lot of utility in a bunch of different ways from Google, and they make money by selling ads on your activity and, you know, your engagement and whatever. And I think with Grammarly, like a business model that is direct to consumer or SaaS feels like we deliver you a service and we have to make that service smarter by learning from you. It feels like a pretty transparent trade. And I think we're going to see a lot of like machine learning enabled tools that look like that.
That's good. Because I think Grammarly is successful because it's useful for the vast majority of people that are out there that do type. And everyone writes at least some words for a living if you're on a computer. So back to the round led by General Catalyst. Previously, they had raised $110 million in 2017. Other investors include IVP, and it costs between $12 and $30 a month, depending on what you need.
And did we mention that they were bootstrapped for several years? So they were bootstrapped for, we think, close to 8 years.
Close to 8 years, yeah.
Which is interesting just because oftentimes companies, you know, go out to raise VC in the first couple of years or even right away. Less often do you see a company bootstrap that long and then go on to become a unicorn, so to speak.
Also, one last little detail. Kate and I were at dinner a while back now, and the CEO from Grammarly was there, and I met him, and I made my same complaint about wanting to bend English. And he was like, here's my business card, email me, we'll figure it out. And I hate it when a founder is that responsive. Yeah. You can't ever talk crap about someone who's like, oh, there's an issue? Let me know. We'll work on it immediately.
See, but why didn't he tell us?
I did not.
Why didn't he tell us that they raised $90 million?
Yeah, that was kind of weird.
That would have been really nice.
That would have been lovely. Anyways, let's move on to a company called Lattice, which has raised a $25 million Series C. And the reason why we wanted to bring this one up is because it's an example of preemption. Kate, you knew about how this round came to be.
Yeah, so Lattice is a employee performance and engagement management tool. So kind of a way for you to notify your boss if you're feeling unhappy and for them to know how you're doing overall. The company's raised, some money in the past. They recently raised $25 million, and they were not fundraising at all. But this is something that's pretty common nowadays. A firm called Tiger Global approached them and said, "Hey, we'll double your valuation. We want to invest in you. Like no board seat, nothing. It's very hands off." Yeah,
no board seat.
Yeah. I mean, they didn't want one. Tiger Global didn't take a board seat. So it was just kind of like, I'm curious what you think about that, but it seemed like they were just like, take the money and grow, and we just want, it's just for them. I think they've been exploring more early stage SaaS companies and making more bets early on. This is a sort of a massive hedge fund of sorts.
Yeah,
they're quite mysterious as well, but they are making this play and continuing to sort of make bets. I think as early as like the B.
I mean, this is a small C for 2019, but is your firm seeing Tiger kind of drop down into earlier stage B2B SaaS like this?
I'm trying to think about Tiger specifically. I'd say like their performance would show they've been really smart investors globally in technology. I think when you see hedge funds more generally like reach into still relatively early stage companies, it becomes further and further away from what their traditional like sweet spot of business model has become, right? And I think you're seeing that because valuations went up most aggressively, and competitiveness of like sort of being able to invest went up most aggressively in growth rounds first over the last 10 years.
So we're seeing that trickle down into the earlier rounds.
I think we definitely see more and more players trying to move early. We're a firm that's always been focused on being early stage investors. So it's something we think about, but it's a very different way to practice investing. And I actually think this is like employee engagement is an interesting category. HR software is something we've done for a long time, but we tend to be active investors and take board seats because, early on, first of all, just believing in governance and being like a partner that the entrepreneur wants around the table in an active way. But also, like, as we've sort of seen with a bunch of companies relatively recently, like, not having governance gets you into trouble over the course of time.
Dude, sorry, we weren't going to talk about WeWork the entire episode, and then you just totally brought them up.
I'm not trying to hijack.
It's totally fine.
Well, do you guys take a board seat every single investment?
Not every single investment, but like our core strategy is to do relatively early stage investments where we take board seats.
And why wouldn't you?
That's most of them.
Why wouldn't you take a board seat? What would be like an example of a situation in which you would not take one?
So I think some part of it is also just what does the board look like already?
Yeah.
So like we're super happy to be investors in a company called Roblox. We wrote a very significant check. My partner David C is very active with the company, but they also had like a pretty full board of investors already. And so we can be very helpful to Dave, you know, with his mature company and mature board without saying like, you know, you already have a number of partners around the table. We don't feel like we have to have that.
Right.
Roblox is the gaming platform aimed at kids where you can kind of make your own game inside of this. It's kind of like Lego meets Minecraft, but you can make games.
Yep, totally. So it's one combination like community gaming platform and game.
Yeah, my friend Matt Kaufman works there, and he's been there for a while now, and he's having a blast. And because of that, I actually downloaded it and played it because I wanted to try it out. And I realized I was about 2 decades above the target age. But if I was a kid, I think it'd be awesome. So let's scoot on to Clary really quick. So this is a company that works in sales tooling, which is a SaaS category that I have been seeing, I think, more movement in than I expected. I didn't know there was enough space or white space in that niche to let a lot of kind of individual vertical SaaS players move in. The company raised a $60 million round to build out its, quote, sales analytics and forecasting tool. And I believe it's now worth about $500 million, kind of like half a unicorn.
Half a unicorn.
Or half a corn, if you will. Or a very, very kind of small one.
Just a calf.
Calf. What is a unicorn's baby called?
I'm assuming calf. Yeah.
Really? Okay. All right. Another company in this space is Aviso. They're actually based in Redwood City, so just down the bay from us. They've raised $31 million total, and they're doing what's called, quote, AI-powered guided selling. So a lot of people are in this space, and to me, it makes a lot of sense because every sales team has a software and tooling budget. Why not go after that? It shouldn't all go to paying Salesforce. Mark Benioff has enough money. I don't know. I mean, are you seeing people still building like early stage companies in the sales enablement space, or does it feel more filled in from your perspective?
I mean, we really believe that there's like a Cambrian explosion of SaaS companies that are going to be really valuable still happening in the early stages right now. Sales enablement is something that like actually matters to every business.
Every business.
Or, you know, almost all businesses. And I think there's an awful lot of room around Salesforce just because it's not as engaging or enabling or as analytical as it could be. And it's a huge ecosystem. So I think it's an interesting space. It's a little, as you said, you know, there's a number of players now.
Yeah, but I mean, there's so much TAM. I mean, surely they don't have to consolidate into one winner. There's gonna be a lot of space for probably a multi-party winner set up somewhere down the road. I don't know. I find it pretty exciting. Vertical SaaS, I think is what you were kind of indicating there, is doing well. I've actually talked to people that are building like dental office software. They're focused on the dental niche. I don't know. Yeah,
we definitely think about like verticals, departments, new audiences like SMBs or relatively new audiences. But I agree with you. I think the TAM is there. And then in an area where you have a lot of players, because a lot of people see the business opportunity, then we're thinking about like where the networked plays, like who has a thesis for why they can be, if not Salesforce, something that big.
Do you think we're going to see a startup supplant Salesforce and kind of where it's in the market in the next 10 years?
I hope so.
Oh, you hope so? Okay.
I think and like coming from a user perspective, like there are a lot of people that don't want to take every action in Salesforce and don't feel like Salesforce supports like the data and analytics that they want to go do for their businesses. And it's an amazing company, don't get me wrong. And I think they've done like very smart strategic things in terms of like they're pretty supportive of their ecosystem.
They are.
Right? And because it embeds them as the database of record for customers. I think if they continue to do that, then they'll continue to do really well. But I also think that like the kind of data that people want on their customers and the things they want to enable people with just rapidly changes. So I definitely think it's possible.
It would be a
and if you have a good thesis, call me.
Yeah. Okay, let's move on and talk about the global kind of venture scene, if you will. I wanted to bounce some stuff off of you guys. First thing that we looked at some data about what was going on in the third quarter, and we saw that Series B rounds domestically were a little bit light in Q3, according to reported data from the 3-month period. And globally, Series A rounds were a little bit light. And so we had this kind of weird discrepancy between where in the early stage venture market, things were both doing well and not doing well. But before the show, we also mentioned that things seem to be, in general, very strong.
Yeah.
So,
I mean, I feel like that's just us looking for a slowdown somewhere. But overall, I mean, we're seeing high deal value. We're seeing tons of deals. I don't think it's like by any means a low year for VC.
No.
So really it's just, we're seeing a little bit less. I mean, I didn't look at the data, but we're just seeing a little bit less Series B rounds in the US.
Yeah. Enough that it stood out a little bit, but it wasn't like a catastrophic decline. We're not seeing like a long-term Series B crunch.
We're also seeing massive Series A's too. So it's kind of like the whole thing, as we talk about all the time, the whole thing is just becoming, these various stages are becoming more and more meshed together and harder to differentiate.
Right. As they get larger, Series A is no longer 5. Now it can be 50 or
Series C can be 20 million or it can be 500 million.
Well, we have a $25 million Series C in today's notes and a $60 million Series D. So apparently numbers just don't matter.
Yeah, the last time we looked at the data and talked to our LPs about it, it was, at new highs, right? In the last 6 months. It doesn't feel to me like there's any less opportunity or any less competition in terms of the amount of capital available. So I don't feel like it's any different. I think there's a little bit more wariness in terms of should we value every company in the sort of late stage pre-IPO market like it's going to be a breakout winner. Like I think people are realizing that that's less healthy. But it's less where we play. And so like to your point about, stage, like the definition is very confusing now. Like we focus on early is, I think competitive, but more differentiated than other areas. And it doesn't feel any less busy than it's been in a very long time.
To your point about valuations, do you mean sort of people are realizing these inflated valuations are not healthy? Or what do you mean by like, oh, it'll be a standout company, so we should give it a standout company valuation?
Well, I don't want to bring us back to SaaS multiples, but I will.
But I will.
No, I think the like when as an industry tech labels a company a unicorn or a decacorn or like what is happening is one individual private investor is saying, I'm willing to make a bet on this company at this price.
Yeah.
Right? That doesn't guarantee anything about the company's durability or importance or business model.
Yeah, it doesn't necessarily mean anything either.
Right. It's just like, I'm saying that I'm willing to take a career bet on it as an individual investor.
Yeah.
And so I think people are just recognizing that that's not necessarily a guarantee. And at some point you have to reckon with like being a great durable company, like profitability or raising more money or the public markets, or what acquirers think about multiples, for example. And so I think that's healthy for the industry. I'm not predicting that, causes the general turnaround, but like the sentiment I've seen change is not like any less Series B, Series A interest. It's more, do we really want to what does assigning this huge price at the growth stage mean for a company?
But going back to your point about multiples, companies that will be breakout companies, I think you said, can engender a higher multiple because you think they're going to be a much stronger eventual result, whereas more quality but not going to be slack companies will get a smaller multiple because it's a more conservative bet because you're not as expecting that it's going to do as well. And so it would change the math. That makes perfect sense.
Yeah, I think like if investors were like smart and making a bunch of great decisions about how to choose, that would be exactly what would happen, right? But I actually think that's, there's been a lot of pricing of every company like it's going to be Zoom or Salesforce or Workday.
Do you think that was just the competitive dynamics of the late stage kind of growth stage market, or do you think that was optimism gone awry on behalf of the VCs and they were just, too rosy tinted in how they viewed the late stage market itself?
So earlier this year, I gave a presentation to our LPs that said two things can be true at once. We think there's more opportunity than ever before in terms of like how good of a business model subscription software is and how big these companies can get and how capital efficient they can grow. But the other thing that can be true is that there's an awful lot more capital than there's been in certainly the last 7 years I've been at venture. Right. So I think both things are true. And one of the challenges is just like you're in great shape if you choose the great companies and not if you price everything like it's Zoom on the Series E.
On the subject of profitability, at the early stage, how often are you actually seeing profitable companies that you are investing in?
It's uncommon because like I think about the way the name of the game of venture to me is get to market leadership as quickly as you can in a capital efficient way in a market that we care about, right? And so like, the priority there is market leadership.
Yeah.
Because whatever else you think about Uber, having, the Uber user base and brand and all of that and network is very valuable, right? So market leadership in SaaS or in consumer is like sort of a core driver of like what venture-backed companies, at least by Greylock, are trying to get to. And usually that overtakes profitability as an objective in the near term. But like we always want to see, obviously, what the future path toward that profitability is.
There needs to be opportunity there, right? To become profitable one day.
Not just opportunity, but like a pretty clear set of principles for how we're going to
But that hasn't always been, right? Like that's why we've seen companies like WeWork get to this stage. They never had the clearest path, but they still were able to, actually reach a valuation of $47 billion. But like exactly what you said, that was because one investor, or SoftBank, continued to, expand their valuation over deals. It wasn't like it was multiple investors. Like they really took the lead there, being like, hey, we think this company is worth nearly $50 billion.
I'm always wary to use WeWork or the We company as a data point because it's such an outlier. It almost feels like it's broken. But an example of this would be Dropbox, because they were worth $10 billion back in 2014 and they're worth $8.1 billion today. So someone took a bet on that company full of faith and excitement about the business and ended up overvaluing it pretty early. And then that almost put like a heavy collar around their neck, because then they had to kind of carry that around with them through their IPO and set overly high expectations. If they'd been priced at $6 billion back then they would have gone public at 10 and looked like a huge success story. So you can get ahead of your skis. I'm curious though if the SoftBank implosions that Kate mentioned will change sentiment enough to bring some of that enthusiasm and overpricing down among other growth stage
investors. Seems like VCs are I don't know. You guys probably read was it Fred Wilson? Yeah, Fred Wilson. He wrote a blog post about how so many companies, like say in the real estate business, are getting tech valuations when they should be valued like real estate businesses, and that was what went wrong with WeWork.
I did read that.
Yeah. So I think that ignited a big conversation around like things like profitability, things like software multiples versus like real estate multiples, or there are so many businesses that are like insurance businesses, but they're tech enabled, or real estate businesses, but they're tech enabled, or like all these different things where they overlap from industries, and because of that they've gotten tech valuations. But maybe we need to reevaluate how companies are valued just like overall.
Yeah. So when we talk about SaaS multiples, which apparently we just talk about all the show, which is great. The reason why SaaS multiples can be so high and they're a multiple of revenue and not EBITDA or like net income is because you have incredibly high margin revenue. It's often recurring and it often has an expansion component built into it, which means that revenue is profitable and then durable. A company that does like groceries usually trades at 0.5x revenue because it's the opposite.
Right.
So the question then becomes, where do you value Instacart? And this is where the game begins. Do you value Instacart more like a software company, or do you value them more like a grocery business? And you can apply that to a lot of other areas inside
That's
of
a great
venture.
Example, because they're definitely overvalued. What are they worth? Like $8 billion?
Well, I'm not going to say, I'm not seeing their numbers, so I don't know offhand. Maybe they've got amazing gross margins and I'm totally wrong. But I mean, if you ascribe a 10x multiple to everything that has a tech-enabled component and it doesn't have the main qualities that make SaaS companies distinct and therefore more valuable on a per dollar revenue basis, you're going to make a mistake. And that's a bit of like, it feels like anti-lunacy coming into the market, which is quite enjoyable to watch.
I think it's exactly what Alex said in terms of, does the company have fundamental advantages in their business model that means you should treat them like an advantage business that should have a 10x revenue multiple or not, right? And so just saying something as a tech company doesn't make it so, for sure. I think it goes down to every specific example because there's lots of moats around different companies, including customer relationships, network, ecosystem, just being a SaaS business, which is a great business. But I think one of the things that like I love for the press, the industry, entrepreneurs to glorify as much as like raised huge round at massive valuation is like when companies can sort of achieve what I talked about, which is like market leadership with amazing capital efficiency. Like that means something's really working, right? And that is not something that people sort of talk about, and it's very rare. But some of the companies that we've been a part of that are like franchise companies, like Palo Alto Networks is a $20 billion plus security company. They only ever spent less than $60 million in venture.
That's crazy.
Right. And I think that's kind of unthinkable for a company of their size. But I feel like there's been this sort of fake choice that companies are making between like growth and like great business model, capital efficient. But it isn't just trying to be capital efficient and looking for like a fundamentally strong technology driven business model doesn't mean you're not ambitious, right?
Yeah, no, to be clear, but also going back to your point about the media focusing on the wrong things, I would love...
I meant everybody.
No, but I think it's a really fair point, but I just want to point out why that's the case, because I agree with you. I don't think you're wrong, but I can't talk about a company's, CAC to LTV ratio because they won't tell me. I can't talk about their blended gross margins because they won't tell me. But they will always tell me how much money they raised and from whom. And so that with one fact that I have.
Yep, that's the anchor people have.
And so you run with it.
Because they share that with us, and then it gives us kind of like the avenue to actually write about them. But a lot of these companies that are really great businesses that are capital efficient, kind of like Zoom was for a long time, that was not a company on my radar really at all before they filed to IPO. And I think it's because they didn't necessarily seek any press, which is fair. They were heads down and they didn't really feel the need to do that. But there are companies like that who certainly deserve to be profiled in the same way, but aren't because they may not seek it out or they just don't really share.
And we work as the example of this gone as wrong as it can be. I mean, we ended up writing dozens of profiles about apparently one of the worst executives that we've ever seen in the history of venture capital and private equity. Whoops. And we called, what did the media call him? Not extravagant, eccentric. Turns out he was just nuts. Whoops. So that's kind of on us. Sorry about that. So, but mostly it's SoftBank's fault. But anyways, on last point on this, Smile Direct Club went public, I think in September. We talked about it on the show. And if you want to see a real live market example of public investors say no to private investors' optimism about a company's revenue quality, observe its share price and its revenue multiple compression since it went public. That's a fun little homework assignment because that's good times.
Teledentistry.
Kate loves that word. Let's talk about sobriety before we go.
All right. Okay, so I profiled a startup called Tempest about a week ago. They raised a $10 million Series A from a venture capital firm called Mavron. And this is a company that has a virtual sobriety school. It is I think it's an 8-week program, cost about $600. And they give you a bunch of different resources, lectures, Q&A sessions.
It's weekly, right?
Yes. I think it's weekly lectures, but there's also a lot more that goes on every week. There's worksheets. You're always able to sort of communicate with your classmates. And the goal is to help you get sober.
Yep.
At the end of this 8 weeks. So
sober from alcohol, to be clear.
Sober from alcohol. So it was interesting. So I spoke with the founder. Her name's Holly. She's also writing 2 books, one of them on her own methodology to sobriety. She is a recovering alcoholic. And she kind of claims she sort of she's carved this new path to sobriety, and she thinks it's really great. She says there's no similarities between AA, which is a really common path to sobriety for a lot of folks. She said there's no similarities between Tempest and AA other than that they are helping people get sober.
Yeah, so I agree with that because I'm not a regular. So, well, 1, I'm an alcoholic. 2, I've gone to rehab. And 3, I don't like AA, which makes me unpopular in a lot of sober circles, which is why whenever I see something come up that is not an AA or 12-step based program, I'm immediately attracted to it because it's probably a non-religious thing that you don't have to show up to all the time in like church basements, which is where AA meetings often are. The reaction among me and some of my other sober friends, we have like Twitter DM groups about this stuff, is that we're always a little bit leery of there being a profit component into anything that involves mental health and taking care of people. But at the same time, if this company does well financially, maybe it can bring something to the market that can reach more people, and therefore capitalism will actually allow us to extend this type of service.
Certainly, like we talked about a little bit before, it's not a net negative. I think there are some issues with the profitability element. They are charging a good amount of money for the class. They are also charging a subscription fee for you to stay as part of the community.
Yeah.
Which of course you'd want to because it's not an 8-week journey. It's much longer than that. So I think, of course, you would want to sign up for the subscription community. I think that this is less something that will truly help clinically addicted people, but will more be targeting this new generation or cohort or whatever you want to call it, of people who are really attracted to these startups that are offering non-alcoholic beverages to people who, there's always think pieces about millennials not liking to drink or not drinking. And I think this is for that.
So one thing that I get a lot of people reaching out about is they're not physically addicted to alcohol, but they've been drinking too much and they need to take a break. And I love these people. It's great to talk to them, to encourage them, to get them on like a 30-day break just to see how it feels. If you can't do 30 days, data point. If you can, data point. But if this is a way to help people that are on the edge of this getting worse to teeter back into safety and take better control of their lives and make better, healthier choices for them and the people around them, hugely in favor of it. If it ends up being something that people that are in the throes of serious addiction misuse as a way to actually get the help that they need, then I'm less enthused about it. But there's one more component of this that we wanted to touch on, which is that it's aimed at women and
historically oppressed individuals was the wording of the company. So it is true that AA is majority white and majority male. According to AA's own data about some of the polls that they've done with their participants. So this is sort of something that's tailored for women and again, historically oppressed individuals. What that really means is pretty hard to articulate because I can't tell by looking at the website. I can see that it has branding that is very D2C, that is very startup-y. And sure, that might be attractive to some women, but I don't know otherwise what they might be doing that could actually better help those people.
Well, you can't start any worse than AA did, because if you read the AA Big Book, there's literally a chapter entitled "To the Wives," as if women couldn't be alcoholics and this was only a man's problem. So like,
AA was founded in like 1935 too, so it's like a completely different.
It shows, but there's a religious adherence to the text, and people do not want to amend the Big Book in any way. So this persists, and they still hand it out to women. And so to me, if you just don't start from an inherently sexist position, you'll do better than AA has historically.
Taking a step back, just like, what do you think generally about all these brands, these new beverage brands? There's so many of them. There's CBD infused soda. There's House, which we talked about, which is still alcoholic, but just less alcoholic, and they're all getting venture capital rounds.
Yeah, D2C brands are a little outside of my zone at Greylock, and I think we generally have been investing in like the growth of e-commerce and new distribution channels to customers, like incredibly interesting, like real trend. I think the question of like how large does any one of these brands become? What is the durability of that? Like a lot of these companies are getting to outcomes too, right? But I think it's just about focus. And I think like I'm a consumer of all of this stuff.
Yeah.
I'd say we are generally more interested in things that like enable the entire ecosystem. So
as a consumer,
Amazon infrastructure, not necessarily the beverage, even if some of these I think are great real businesses.
As a consumer, are you more bullish or bearish on D2C in general? Not as a VC, but just like as a person.
Oh, as a human being, I buy a lot of stuff that advertises to me on Instagram. That's a brand I've never heard of, where I'm like, no brand loyalty, my people, right?
And that's why CAC has gone up so high for Instagram ads, because they absolutely work.
And there's one theory on it, like that their Instagram is this amazing channel to reach consumers and with like aspirational lifestyle advertising. Lots of consumer brands, was an arbitrage that existed for a certain amount of time, and like now it's
since gone away.
I like buying D2C brands in brick and mortar stores.
Well, aren't you just contrarian?
I feel like that's honestly the only time that I ever buy stuff that's created to be D2C.
I'm just amazed by being off Instagram, how blissfully unaware of all D2C I am. Like, because I've been off for about a year and a half now.
It's fun.
I just have a lot more money because I don't have more stuff. It's this great trade-off that I have. Anyways, we are over time. So Sarah, thank you for coming on with us today.
Thanks for joining us.
We appreciate it. And Kate,
Super fun.
I'll see you soon.
See you next time.